Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. All three of you? I'm just kidding. Sometimes it seems like that, but a lot of stuff going on. It's just, I've been in disbelief of a lot of things that have been happening over the past few years. Just did not expect it. We would still be doing kind of stuff like this at this stage of the game. I just kind of thought we would be beyond this, but here we are, and that's okay. Actually, the financial markets have actually withstood this pretty well. I'm amazed. I'm just looking at the S&P 500. It's only down about 9% from its all-time high, which was just reached a couple of weeks ago. Market just reached an all-time high a couple of weeks ago. And it doesn't even, the volume's picked up a little bit, but not a lot. So I guess the verdict is still out on this. And it's just barely, it broke below the 20-day low. And if nobody knows what that is, don't worry about it. It's just an indicator that was created a long time ago. And basically it's for shorter term trends in the market. So the shorter term trend is now down. And I would tell you that that's probably a pretty good thing. Why would I say that? Well, I know it makes everybody upset. That's because you haven't been studying charts as long as I have, or cycles. It's it keeps going straight up. You get really high valuations, and the higher the valuation gets, the more risk there is when inevitably at some point in time it does correct. And that's what we're going through right now. Some small correction. It's actually relatively small. In fact, let's see. The first quarter of the year, market hit a new multi-year high. Goes from 610. This is the SPY, by the way. That's the S&P 500 ETF. And it was down about almost 20%. And then it recovered all that, went to a new high, and now it's pulling back a little bit again. And that is exactly how it's supposed to work. I mean, if you've been watching this for an extremely long time period, this would not upset you too much. What is upsetting, and the news media has to sensationalize just about everything, and our current administration doesn't mind helping them out. Doing a bunch of stuff they probably shouldn't be doing, and that's not unusual. But not for, at least for this administration over the last few years. It's been kind of crazy. But I think the one of my best sources of information, as far as I'm concerned, my two best sources. One is the Bloomberg terminal that I subscribe to. It's got, if anything you ever wanted to know about a company, it's in there. It is absolutely in there. And then I really like The Economist on the cover of this last edition. It says Operation Blind Fury. And it's got a picture of, well, I'm just assuming it's supposed to be Trump. If you see it, you'll know why. And he's got a helmet on, and the strap, he's got the helmet strapped on. It's backwards, and it's covering his eyes. And there are bullets on the back of the helmet. But pretty good picture, actually. I thought, yeah, that is so funny. That actually brings a little lightness to to all the darkness that's going on. And it also reminded me, I had a lady come in. She was talking about, this is, oh, geez, at least 20 years ago. Okay? And she was talking about her portfolio, and she's talking about the stock market, and she, is a very nice person, and she leans over and goes, war is really good for the stock market. I was like, she's telling me, like, we were only two in my office, and the other two people that work with me there, they weren't close enough to be able to hear anyway. But she whispered that war was really good for an economy, and I started laughing a little bit, but because of the way she said it, actually. And but then I started thinking about it, and yeah, it actually is. World War II ended the Depression in the United States. We had all this unpaid debt, and all of a sudden, big war breaks out. We get sucked into it, and guess what? Now we're going deeper into debt to pay for all the equipment, the uniforms, bullets, meals, tents, uniforms, all that stuff. Yeah, it forces the country to start spending, and they have to borrow to spend, and which is worrisome to an awful lot of people. If the debt gets too big, then the amount of money that we have to pay on interest starts to squeeze a lot of the other programs, because there's not enough money for the other programs if we're paying it all in interest on debt. Nobody ever knows exactly where that spot is. What is the one spot that it can't borrow more than this, because we've blown through those numbers multiple times. And ultimately, yeah, that's going to lead to a higher inflation. But see, that's the thing about the stock market, especially the S&P 500 or the Russell 1000. Those are the 1,000 biggest companies in the country, and the S&P 500 are the 500 biggest. And their Russell 1000 contains the S&P 500. In fact, let me see. Within probably 3 or 4 months, I might do another seminar. I haven't done a seminar in years. But I was thinking about doing one because I think this is really important. And it's been so long since I've done the last one. A lot of people are growing up. A lot of people are every day. The fastest growing segment of the population is 50 and over. Think about that for a second. Fastest growing segment of the population in America is 50 and over. And I forgot, I think it's 10,000 people turn 50 every day or something like that. It's and who knows who the pollsters are, but or how accurate it is. But it's a real thing. The population is still growing. We grow by about 3%, but as it's growing, people are waiting to have kids until they're much older than they used to. And so the average age of the whole population is a little bit older. What does that mean? Just you have to prepare. Is it going to end Social Security because they get so many people on Social Security and so few people working? Probably not. That's something that's really, it's used a lot to scare people into voting a certain way. That's my opinion. I am full of conspiracies this morning. But anyway, things are actually going pretty well. And you look at the number of advancements in technology, that is not slowing down at all. The ability to fund it all, you're probably not going to be able to do everything. And that's actually, if you look back over history in the world, the That's what happened fairly significantly or fairly consistently. There were lots of inventions that had come out decades before they actually made it to the general public, and now we, use them like we don't even notice that's a pretty significant piece of technology you're holding there and you're bringing around with you. And especially if you look at the cell phone, my gosh, the amount of information that stores. I remember buying my first computer. It was a personal computer. They didn't, and it was big. It was a really big machine, and it had this an entire 250 megabyte. Most kids don't know what megabyte is now because they haven't used that term for so long. The 250 megabyte hard drive, and that was the state of the art, and it was really expensive for its day. I think I paid around $2,500 for it. And people say, "Well, $2,500? Yeah, you paid $2,500 for a computer?" Yeah. And by the way, it wasn't that was in like $1988, when it was a lot more money than that. I just really like I like the field that I'm in. I like to be able to do up to the minute research, and it's very helpful, especially picking out various strategies. There are an unbelievable number of strategies we have to select from. But it's a few thousand, quite frankly. What really is funny to me is that there are only around a little over 3,000 stocks big enough to be able to invest, or for an institution to be able to invest in, because there are certain liquidity requirements that they need. So basically, the Russell 3000 is an index it's 99.5% or whatever it is. It's a really high percentage of the available stocks that you can invest in. The reason that I just don't do that and forget about it is that it's market capitalization weighted, and most of the money, more of the money goes into the bigger stocks, and a very small amount goes into that last couple hundred stocks there. So if they don't all move together, it's not really going to have much of an impact on things, on your portfolio. And I know this, I'm getting deep in the woods here. So I'll stop talking about the technical stuff anyway. That's the kind of stuff that means something to people like myself who look at the statistics, and that's all it is statistics. That you have to know which ones to look at. It'll take you a while if you haven't. It's one of the reasons I still have a job today. And even when you get all the statistics, they are constantly changing. It's not like huge overnight big changes. That is extremely rare. Extremely. I can't even remember the last time that happened. But it's small, consistent changes over time that end up adding up to a lot. Very similar to the way your portfolios accumulate while you're waiting for retirement. You keep adding to it. You keep adding to it. At some point in time, your portfolio gets so big that your additions really, as a percentage of the your total, is very small. Very small. But you're still doing it, and it still helps. And I think it helps a lot more psychologically, knowing that and when you're in the accumulation phase of your lifetime, that you keep adding stuff to it. So when it's down, your contributions are buying more shares. Why? Because the share prices are lower. Are the companies doing any less business? Probably not. In most cases, are they going out of business? Some of them probably will, but not many. I can't imagine Intel, or Microsoft or Google or any number of other big companies. There are tons of big companies, especially the way things are changing now. Natural gas utilities have become growth stocks because you've got to generate so much electricity for all the electricity that we're all consuming every day. And these data centers that they're using, putting up all over the country, all over the world for that matter, to be able to store and save this data, because they've got to have backups there. And anyway, there's just an awful lot of stuff that's going on. And the regular media doesn't talk about this because they really can't afford to. And I get it. They need attention. They need your eyes. They need you clicking on those websites, watching the channels, reading the magazines and newspapers, which are still a thing. I know they are because I just went to Barnes & Noble. And I bought a magazine to bring in with me for the radio show today. Anyway, I got to take a real quick commercial break. This is Bill Bullington. I'm right here on 1420. I'll be back after these messages.
Before there was time, there were visions in your...
And I'm back. Like it or not. That's getting old. I'll stop using that now. Sometimes I get bored. And actually, markets to me are kind of boring, after all these years, because there's only so much you can know, and there's only so much that's meaningful, and change is not nearly as fast, even though the market is equipped to handle fast change, much more so than it has been ever in its history. But it really doesn't change all that fast anymore. And I think there were a lot bigger changes during my career that used to come along, which you really need to have to sit up and pay attention to. But man, it is despite the fact they have the capacity to change, the desire is kind of waning a little bit. It's just a little bit slower. Markets are still volatile, and the average range of an average stock on a major exchange is still close to 50% a year. That's a lot. And imagine that. When a stock drops by 50%, do you know how much it has to go up by to get back to break even? It's got to go up 100%. Think about that. You drop 50%, now you're going to have to double your money just to get back to break even. One of the reasons you probably want to diversify and hold a couple different asset classes when you're looking at that. And that's one of the things, it's actually always kind of been this way. I always marvel at the confidence of a lot of people that I talk to. They'll call up or I was at this celebration a couple weeks ago. And there was a lady in there, and she was must have been drinking. She's picking fights with me about knowledge about stocks. And after about an hour, I broke down and just said, okay, what's the price to sales ratio of the S&P 500? You don't know that? Surprise, surprise. Yeah. And if you don't know that, that's, you should learn it. And I think advisors, are advisors worth it? It depends on who you are, of course, because you can learn anything you want to learn. I mean, you can learn how to do surgery on yourself on YouTube. I'm sure there are channels out there that'll show you that. But it's pretty important. And I'm making light of it. It's actually not all that funny because you make a big mistake financially, and it could be years, before you recover. I mean, absolutely years. So you got to be careful with that. And it's something that I don't know. I would, if I didn't do what I'm doing for a living, I'd find somebody that did, because the change is massive, and some of the time. Sometimes it's just a little, and you don't have to make any adjustments. But when you get those big ones, it pays. It really pays. And I use we have a whole slate of different investment programs available to us, and most firms do today. Most of your bigger firms have it's a few hundred, if not a couple thousand. So the idea is that you want to be able to appease as many people as you can. When I say appease, I mean get them something that they're probably not going to like everything there is to like about stocks or financial markets, because it's challenging. That's to say the least. and it changes quite often. So the funds that I use and the portfolios I use, they're making changes as necessary. And I think the S&P 500, it rebalances, it restructures the index once a year. So it comes in and says, okay, last year these were the biggest 500 by size, but they've all changed during the year. They're actually updating that. But once a year they'll come in, and if new companies have come along and have gotten big enough to be included, they're going to add those, and they're going to subtract out the ones that fell too small to be counted in there anymore. It's a lot of work. And I'm glad I have a huge number of people to try to help us out, because it's a lot. It's just a lot. And I look out at the general public. I know that things are probably getting a little bit rough when I get calls from certain people over the years have called. They're calling just to, I think just to hear the sound of my voice to see whether or not I'm panicked. And I have news for you. I never panic. So I've never been one to panic a lot, even when I was a kid. So, that's investing. It's like 95% mental, 5% knowledge. Realistically, 5%, and that's my opinion. It's easy to say, and it's easy to know what you should be doing. It can be very difficult to get yourself to do it if you need to. And quite frankly, a lot of people just don't want to take the time to become, an expert at investing. It's just that's one of the other reasons I still have a job, is because you can look up the answers to anything now. It's mind-boggling how much information comes available every single day. Are you going to be able to keep up with the changes? But, probably if you put the time in, are you going to be able to pick funds that can do that for you? I don't know. It really, like I said, I've met with a lot of people and have a lot of confidence. Look how good I'm doing. Well, can you explain where those returns came from? Do you know what the top 10 stocks in your biggest funds are? No? Oh, surprise. Not really. But, it's important. Some things can go along seemingly very well for a long time period. And I can tell you that the easiest or most money comes into a fund or a sector when it's 10 to 15% away from its all-time high, then came in when it was 10 or 15% from a multi-year low. And that's common. That happens all the time. And it's because these guys don't know how to put the brakes on. And it shouldn't be. I would not try to gauge it based on the price action of the underlying investment. Let's say you're looking at the S&P 500, so SPY. I would not try to invest in that on its own by itself. I would take a look at how that's doing relative to all the other stocks in the market. And how are you going to do that? Well, it's going to take you some time. You're probably going to have to spend some money on data that you get. But anyway, I'm trying to. Probably sounds pretty hard. I know a lot of people are just, as you get closer to retirement age, what do you do? You're starting to think about collecting Social Security and retiring, and there are a lot of decisions you got to come up with during that period. We try to help our clients the best we can. I'm amazed at how many people actually give it a lot of thought. It's a lot more frequent than when I was young in this industry. I mean, people just didn't talk about it. They didn't think about it too much until it was right up on them. A fairly significant portion of the economy, or of the population probably did that. And I'm just going from my own experience. I haven't corroborated this with a multi-million-dollar study. Probably never will. But I read a lot, and I pay a lot of money for research that I'm getting to. And so they talk to us about what clients are currently, or potential clients, or people that are in certain demographic categories are thinking about. And it's fairly similar to the way it was 10, 15 years ago. It's changed fairly significantly from the past 20 years ago, 2025. And but most people are just want to know that, hey, am I going to be okay? And is Social Security going to be there? And here's something I would tell you about Social Security. This is a riot as far as I'm concerned. And sometimes I get in trouble saying stuff like that because people are taking it real seriously, and I take it seriously. But I hear all these stories, these made-up stories, and they're going to cut, so you're going to eliminate Social Security. No, they're not. Are you kidding? You want to see a complete overhaul of Congress and the Senate and the president? Cut Social Security. Just take it down by 1 or 2%, and you're going to see a massive restructuring of our entire governmental system. That's one of the reasons the United States is such a good country, and people want to come here. We don't have to have a war to get rid of a president. We just wait till the end of his term, vote for somebody else. And that's is that under siege now? Is somebody going to try to control and become that single dictator? They might. But you know what? I'm pretty sure they're going to get beaten when they do that. You think things are rambunctious now? Try something like that, and it's going to be a big deal. Are they dumb enough to try? I don't know. I don't know if they're dumb enough to try that, but if they do, I think they're going to be met with an unbelievable amount of resistance, and I think people will rise up. Just call us the new 1776. Anyway, I'll quit talking about that stuff. It's not really going to help all that much anyway. And another thing is kind of wild. I thought that I would study economics when I was going to college. I thought it would help. Man, that is a long time ago, and was very helpful though, because the things that really matter, kind of like gravity. New modern planes look a whole lot. Well, they look somewhat similar, but they do things a lot differently than planes back in the 1960s or 50s would have done. But they achieve the same goals. And that's kind of the way things go. Yeah, their change is going to be smoother. You can probably go higher, faster. You're improving. Hopefully, we're improving all the time. But the basics are still there. And you still have to pay attention to that. Now, some of the tools that we can use, like I love the fact that I've got a portfolio that somebody else is managing. I selected that manager intentionally, and they're doing exactly what they said they would. And it's a market cap weighted stock portfolio that I'm like, when I first saw it, I was like, nobody's going to. There's way too many small, tiny little details in doing something like that. They cannot offer that across the entire country. And I was wrong. Thankfully, I didn't think they would go that far, to bend over that far to really make this happen. And I'm elated. I mean, I've had some of the best records relative to the S&P. Now, if anybody that's been in, let's see, we are actually seeing prices that we had gotten into. Where is this? Okay. Now, it's almost over a year ago. Or no, not a year ago. About 9 months ago. And my computer's giving me a hard time. But about 9 months ago. So market went up, waffled around, has a pullback, was down it's 1.67% on Friday, closed near the low of the day. The volume was relatively light. The heavy volume that came in recently, that is more heavily, it's about 50% more than its average, which is not a gigantic spike up in volume, but it was actually a normal down day, but it bounced up fairly significantly from its low off the day, and the next day it gapped open, shot up higher than the previous 2 days, and then it comes right back down, goes below the open, and then closes slightly above the open. Does that mean anything? Not really. It means the market is not, the sentiment was pretty much undecided, which is pretty good, because if you look at Friday, it looks like they were deciding that it was negative by the market's action. It opened at a lower price than it closed at the day before, and the day before it closed near the low of the day, goes down, barely bounces back and closes near the low of the day on a slight increase in volume. Not a big spike. So what can we make from that? Probably nothing. It's probably nothing. And I remember studying this stuff so hard. There was a time when you could take a look at charts and they actually meant something. I think that those days are over, because you've got so many computers that are running the markets. They're not run by people anymore. And you see the New York Stock Exchange; those guys are, they're there to supposedly help some of the transactions on when big, super huge trades come in that they don't want to go through the computer system, because if they do, they know how the computer system's going to settle those trades, and they'll come in and slow it down. That's basically one of their biggest jobs, is to try to keep the volatility low as they can anyway. Anyway, this is Bill Bullington. I'm right here on 1420 every Saturday morning from 10 to noon now. And I got to take a real quick commercial break. I'll be back after these messages.
You see that I am new.
We're back. I got a few really good ideas this morning. I'm going to have to go back and research them, and I'll come back with it, the material that I'm thinking of next Saturday morning. It's interesting. I really appreciate the press, and I really like the Economist magazine. They seem to be not overly biased one way or another, and they're just reporting on stories, stuff that's happening. They're not taking sides on most of it. Some of it they do, and every publication, I think, at some point in time starts to lean one way or the other. And sometimes they're leaning both ways at the same time. And that's actually the smartest thing to do, by the way. I would designate a certain space. If you're going to have a certain number of words for one political party, you better have them for all the others. Just be balanced. Tell everybody's story, even the ones that aren't true. But most of them aren't true. I don't know. I'm a real skeptic. I mean, after these, as long as I've been doing this and the things I've seen over the years, holy cow, it's hard to convince me. I'm telling you. Yeah, I will press you if you call. And I've had lots of experience. It's hard to really even put a number around the percentage of benefit that you get from having this. And sometimes it's you know so many things that really prevents you from making a quick decision. That happens quite often. And but when it comes down to how should you structure your portfolio before you go into retirement? How should you be right now? I'll tell you, these guys ticked me off in my industry. There's one aggregator of financial services that they provide to people like myself, financial advisors, and they copied my risk tolerance questionnaire. After all these years, my risk tolerance questionnaire has only got like 3 questions that you have to think about. and one of them in particular is the most important. And so there's only about 6 or 7. Actually, I can't even remember. I'll have to go back and look at it. The compliance makes us redo those things every other year or so. But anyway, the most important question you could ever answer, and this is one of the reasons that when you have an advisor, I think it's one of the reasons you're going to benefit from it. Because if you start thinking about this, what is the maximum amount of decline that you're willing to accept in your portfolio? Most people would say, oh, yeah, 10%. Really? Okay. Well, here's the Bill Bullington rule of doubling your risk tolerance. To find out how much you should put in stocks, double your risk tolerance. So I call it decline tolerance. That's another thing. I'm just waiting for them to copy that because they're still using the phrase risk tolerance. A lot of people don't understand that. So, but they understand a decline. Yeah, that means it's going down. How much of a decline are you willing to put up with in order to reach your goals? Mine's at 30%. That's what my decline tolerance. If I was down 30%, I'm not happy. Okay, but I'm not too upset by it because I understand that that's just how things work. Okay, so take that 30% number and multiply it by 2. Okay, that's 60%. I should be 60% in stock. Actually, mine is 35 because I'm 70%. So I'm willing to be down 35%. So I put 70% of my money in stocks, whatever shape or form. I have individual stocks, ETFs, and institutional mutual funds. So those are in the stock category. And then for bonds, I'm using some institutional bond funds. They have extremely low expenses. And they're I don't think any of them have a maturity that's more than 10 years. The vast majority are around 3. And I'm not the one that has to buy and sell all that crap anymore because these other guys are doing it for me, and they're doing a really good job. I like it. I love it, actually. I think I'm more comfortable now than I was, almost at any point in time in my entire career. And I would say that's absolutely, any other time. Because I can remember when I had to do this stuff myself. I can remember when I went to a conference, Fidelity, one of the largest asset managers and definitely the largest fixed income manager on the planet at the time. Okay, and this was a long time ago. Remember all that debacle that went on around 2008, 2009? That was a big drop, and everybody was really upset, and people are ready to jump off cliffs, not really, but they were upset. And so Fidelity decides to come out, go cross country on a tour with all their top research people. And it's really interesting to be able to get to meet them. Well, we were really lucky because they came to Ohio on a week where it was really cold, unusually cold. And the day they came, it had heated up like it normally does here the day before, and then the temperature dropped like a rock, and after it rained, so everything was ice everywhere. And we drove out to this venue, and the venue's huge, holds a couple thousand people in the audience, and there's only 5 of us. There were literally 5 people. And so the guys at Fidelity go, hey, you guys want to go out for dinner? We'll just go sit around a table. I'm like, sure. So we get to go. I couldn't pay to get that close to that research team. and instead, they're taking us out to dinner. That was hilarious. I had a ball. And anyway, one of the guys asks the guys at Fidelity, the head of research there, and there were like 5 or 6 guys that, like I said, I couldn't get a hold of any other way if I would have called and if I'd have paid big bucks, to get their attention that long. Anyway, the one guy, there was another advisor there, and he says, "Hey, well, what do you think about interest rates?" And he goes, "Well, we think they've got about another couple weeks before they actually bottom out, and it might be might go down another 10% or more." They're talking about the price on bonds dropping by 10%. And I go, excuse me, do you guys know what the yield on the high yield bond index is right now? And these are the dudes, the research department for Fidelity. They all look at each other and they're like, no. And well, it's 15%. So if you're waiting for another 10% decline in the stock market or the bond market, especially the junk bonds, the guy that thing he asked the question of, you'll pick that up in interest payments in the next 12 months. We're buying now, and that was hilarious. We got home the very next day. Those guys went home that same night, and the very next day, they put out a wire across all their RIAs, registered investment advisors across the country. Now's the time to buy high yield bonds. I was like, oh man, I hope I didn't violate any rules with the SEC, because that had a big influence, I'm sure, on that market. That happened to be the best performing category from that point in time to the end of the year. And I'm probably boring like half the people that are listening to this to death, because I know you've heard that story at least 3 times. But just interesting though. Young guy was a lot younger then. Wasn't really that young, but guy from Ohio, points something out, and those guys were cool. They were gracious. They very, very, I guess for lack of a better word, very warm, accepting. Didn't look down on anybody. I couldn't believe how well they treated us, not just because of that, but the whole event. And because those guys were really important people. And as I'm reading the Economist this morning, those thoughts just came back. I guess, where are we now? Well, right now we're in kind of a limbo zone. There are so many things that are up in the air right now. It's not super clear where the market is headed. Flip a coin, basically. It's got 2 directions it can go. It can go up or down, and I think the odds are in the short run, it's 50-50. In the long run, I'm always in favor of stocks over bonds. In the long run, now we haven't had a condition like we had in the 80s since the 80s. I mean, you get short-term money markets are at 18%. Think about that. 18%. By the way, mortgages were 21%. 21%. You're paying 21% on the interest on your mortgage. You pay for 5 years, you've barely gotten anywhere. And they did that. Congress did that intentionally because, they had double-digit inflation throughout most of the 70s. And they finally, Jimmy Carter committed political suicide when he he goes to Paul Volcker, who was the chairman of the Fed, and says, hey, how do we fix this? How do we stop it? We cannot continue with prices doubling every 4 to 5 years. And he goes, well, I can do it, but you'll go down as one of the worst presidents that's ever lived. And Carter says, well, will it fix it? And he goes, yes, it will. He goes, well, then do it. And he did that. I mean, you talk about a patriot. Holy cow. I know I'm probably ticking off everybody that's a Republican, but that was a non-partisan move. He knew it was going to hurt him and his party. Okay. And he did it for the good of the greater public. And, it worked. It was a thing to do. And it worked. Started bringing interest rates back down. But interest rates stayed pretty high. I mean, I think you could still get around 10% on a fixed annuity in 88, 87, 88. So that's how old I am. I can't believe it. And none of this stuff is we're not even close to those things today. And I just don't understand the amount of concern that people have, how worried they are about things. And I think it's because there's too much news. Very few people had cable back in those days. It was slowly working its way across the country. You didn't have 24-hour news coverage anywhere. And heck, most of the time the articles were lagging 1 or 2 days behind the actual events that they were reporting on. So I'm not so sure that being able to access all that information is beneficial. I'm pretty sure it's not. And by the way, I've seen a lot of stories come out that were fake, fake news, and that's a real thing. It's been a real thing now for 10, 15 years, and it's hard. It's really hard, and it's one of the reasons when I left in Bullington Capital, we're a fee-only firm. We do not. It doesn't matter what we're doing. It's not going to change our compensation. So we're flat fee advisors, and I was doing this way before these other firms made it the norm. Was it available? Yeah, it was available. They were charging 3%. But was it common? Nope, wasn't common. You made more money with commission than you did with sales. And some products you're better off paying a commission on. Some products I would argue that an annuity you are way better off paying the commission on that than you would be paying a management fee, because the only products I'm aware of that operate with just management fees, which means there's no penalty period. The ones that I've seen, it jacks the internal expense ratios up so high. I don't know how anybody would make any money. So still a lot of stuff out there that really you have to study fairly significantly before you can make a decent decision on it. And that hasn't changed. So not sure that, in fact, over the last few years, there have been a lot more super complicated products coming out. And that's a little problematic. You can get a bunch of hedged products, and now a lot of the products that used to be specifically for the quote unquote sophisticated investors, the qualified investors, people that have a lot of money or have lots and lots of experience, those problems or those types of portfolios are pretty commonplace now. And even those types of products are they're gonna struggle, I think, to keep up with a lot of the rates. And by the way, the rates are starting to come down on those. So if you're thinking about, well, hey Bill, I'm going to retire here in the next 4 or 5 years, and I'd really like to just be able to lock in a certain amount of income. Okay, that's what I'm talking about. If that's what you'd like to do, that's what I did, and that's what I recommend a lot of people do. Figure out what your basic income needs are. Once you've got that, try to get that done with your pensions, your Social Security, and then annuities. If you need the annuity, if you don't need the annuity, don't get it. Go where you need it, but you're still going to have growth. And I got about 30 seconds here before I have to take a commercial break, so I'm just going to let you know that this is Bill Bullington here every Saturday morning, and from 10 to noon now. And if you'd like to reach out to me, go to my website, bullingtoncapital.com. Feel free to talk about your situation with me over the phone or in person. And I'm going to take a real quick commercial break. I'll be back in a couple minutes. Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you hear anything you'd like to talk about, or you've got questions regarding your own situation, you can always call me or reach out to me through email. It's bill@bullingtoncapital.com. And I'll try to help you the best I can. We specialize in managing money and doing retirement income planning. Now, my position, I guess, my position on retirement planning is that you are never too young to start planning for retirement, because it is a monstrous goal for most people. For the average person, it's tough. I mean, you've got to. The younger you start, the easier it is. The more money you put away, the easier it is. The more money you allocate to a logical stock technique, or whether it's, or a product, mutual funds, managed accounts, I think that's the A+ job. Start when you're in high school. And I know that's really difficult for almost everybody, but you just have to start. If you're working for a company and you've got access to a 401k plan, take advantage of it. Do everything you can, and you'll thank yourself later, over and over again. Because it's a really important thing. It's very difficult to do, and I just keep laughing to myself every time I start thinking about this. I start thinking about my daughter, my youngest daughter, who I really pounded it on her. Well, she actually listened. The other two kind of listened, but not so much. But, they're doing fine. But the youngest one's doing extremely well because she listened and took notes. And in fact, she was going to Walsh College down in North Canton, and she had a educational class, and we were talking about. If I had it to do over again, I'd be a teacher. First of all, I like teaching, which obviously, I do the show. I used to do a whole lot of seminars. I may come up with that one for this spring. But I enjoyed it, and I would have liked to have been a teacher, but my opinions were formed by people who they had strong opinions, but not a lot of knowledge, and how many times does that stuff go bad? You get people that are really loud about something that they really don't know much about. Sounds kind of like a Trump rally. No, I'm just kidding. Actually, Trump supporters, a lot of them are super sophisticated. So I don't think very difficult these days to make a general statement that's going to be true. It's harder than ever, I think. So people are more unique. And I think they listen a lot better. I think they become a lot more prepared. I still think that, don't be diagnosing yourself on one of the medical websites. Go to a doctor for that. And, unless you're going to memorize all the tax laws, and you should probably have a tax preparer that does only taxes, or at least it's a big portion of their job. And same way with attorneys, you got to have them. But consult with experts if you want to, and you can call us up. If this is exactly how I am all the time, every day, I'll just try to answer the question with the best of my ability. And if I can't answer it, I can tell you who you need to talk to, and how you might need to phrase that question so that they understand what you're asking. That's something that still isn't being taught in the business schools. Interpersonal communication. Yeah, now maybe it is. I don't know. I took it because I was curious about what it was. But people don't, I don't know. Communication is rough. And the older I get, the more I value that, because I see that a lot of mistakes, a tremendous number of mistakes, are made not because people are bad people. They miscommunicated. They got it wrong. They misinterpreted something. That's probably the biggest cause of mistakes in almost every field. So I try to keep mine simple. And again, I think I was talking about this a little bit earlier, and I've talked about it my entire career since I decided to use my own risk tolerance questionnaire. And here it is. I started to give it a few minutes ago, and I got off topic. But so here's what you do. Write down the amount of savings you have today. Okay, let's say, just so that I can keep my math easy, that it's $1 million, because that's easy to write. And it's easier to do percentages then. Now start subtracting percentages from that and ask yourself about, how do you feel? Do you think that you would panic? Let's say if you're down 10%, if you went from $1 million down to 900,000, okay, are you panicking? And by the way, you young people or people that have unfortunate circumstances, there's this, a lot of times there's this bad luck and you're not where you would like to be. So if you're in your 50s and you've got $100,000 saved, you're probably going to have to work until 65 minimally. I would say postpone taking Social Security if you can. A lot of people can't, but anyway, bottom line is I'll come back to that a little bit later. Write down what you have and start subtracting percentages from it. And again, to keep my math easy, let's say I've got $1 million. This is just keep the math easy. If you were down by $100,000, if you're down to 900,000, are you upset? And you know what? I'll do both these side by side. If you're at 100,000 and you're down 10%, you're down to 90,000, are you upset? Are you having trouble sleeping? Is it really bothering you? Well, if so, then you don't have a high risk tolerance. You got a low risk tolerance. You have to keep going, though. If let's say you're okay with that, I'm okay because I know that the more volatility that I am willing to accept, okay, the better off I will probably be down the road. We're not allowed to guarantee that, okay, but the probabilities favor. If you've got at least 10 years before retirement, that probabilities are that market will come back and then some over that time period. There are a ton of 10-year periods where the market's been extremely negative. So, anyway, so back to the thought in hand. Just keep taking percentages off. Mine's at 25% now. Actually, I take it back. Mine's at 30%. So if I'm down 30%, I'm not looking to panic and run all the cash. I'm not going to make any major adjustments because the adjustments are being made on my behalf for me based on those numbers. Okay, so if the market were to go down, some of the bonds, some of the safer quote-unquote stuff, we'll come back to that comment in a minute, but so it'll take some of the safer stuff and it'll move over into the stocks. And then if stocks come roaring back, at the time I'm going to rebalance, if they're more than the percentage I initially allocated them to, I'll take some of the money off the stocks, off the riskier assets, move them over into the bonds, and the bonds or the fixed income. Because actually annuities fit in that category. This is really, a lot of people don't like annuities, and I invested in, I've done everything with the money. I've had a Series 3, a 7, a 9, a 10, a 24, a 63, and a 65. I'm the only person alive I know that's done that. Only one dumb enough to spend all that time studying, mostly because I just wanted to know. And a lot of those licenses, they don't even exist anymore, but it was so that I would know what to do with commodities. I had an options training there, futures training, and stock, a lot of stock, government bonds, the corporate bonds, other fixed income, preferred stocks. So a lot of stuff. I really just liked the business and still do. And I'm really thankful for today for the general public, because the amount of portfolios that you have that you can take advantage of today have grown in number and in sophistication. It's very interesting. You can do just about anything that you'd like to do. And which ones are the ones that make the most money? That's what most people say. Well, the ones that make the most money have a tendency to fluctuate more than the others. And that's what you have to decide. That's probably the hardest decision you'll make, is how much fluctuation are you willing to put up with? And that was in my questionnaire. how much of a decline, that's how I worded it, how much of a decline could you withstand in an effort to reach your goals? How much of a decline are you willing to go through? How much pain are you willing to take to be able to get there? Because you're not going to do it pain-free, more than likely. Unless you win the lottery or you inherit millions of dollars, then you really don't have to worry about too much. Actually, you can leave all your money in treasuries and CDs. But for the vast majority of the public, you're going to have to invest in the stock market if you're going to make enough money during your working lifetime to be able to retire. And it's just the way it is, and it's really not bad at all. In fact, I really enjoy it. And if you get lucky, you don't have to be super lucky, because markets spend more time going up than they do going down. So, but if you are one of the lucky ones and you started off and the market went up right away, and when it came down, it never came back to your original investment amount, great. That's awesome. You'll have it easier than other people. If you are adding to it, that's a big deal. That's a really big deal. If you're adding to it, and when you have declining moments, you get to think to yourself, wow, I'm buying a whole bunch of shares at discounted prices. And at some point in time, I'm telling you, they're coming back. And if it is ever really doomsday, okay, well, you're not going to have to worry about the stock market anyway. That's not going to be a big deal. That's not it's not what you'll be thinking about. That's what anyways. And I don't think that's ever. I just don't think it's happening. Man, we have come so far, and despite the fact that they can cover every little detail and try to scare everybody, and that's what most of the news outlets, there's stories, 4 out of 5 of them are negative. 4 out of 5. The number's probably higher than that now. That's an old statistic, but I guess what I'm trying to say here is the battle is in your head. Doing what you need to do physically, make the trades, doing the analysis, looking at your portfolios, that stuff is it's all math. But the ability to sit there and make good decisions while you're looking at all that stuff, that's psychological. And I'm telling you, it's 95% psychological, 5% math. And the math is important, and it can get pretty complicated. But much more important is your mindset. How do you think about this stuff? That's one of the reasons I'm very thankful that during my younger life I played sports. Because there are lots of times when your team is down and you can't just give up and walk off the field. You got to come back. Try harder. I can't tell you how many times I played on teams where we would get behind in a game and then came back and won. So having all that experience, I think it's great for kids. And I would absolutely put your kids in sports, because the thing that's next closest to sports in their lives are going to be their investments in financial markets. A lot of similarities. Coming from behind, facing adversity, things not going the way that you planned, essentially. And I think that's just wonderful training for kids. And I keep thinking that at some point in time, they should come out with some sort of a workbook that talks about a lot of the things that I talk about on my radio program. I have talked about them for 30 years now. I'm still waiting on that book. I'm not writing it. It's just, I hate writing. It's one of the reasons I stopped. I took so many writing classes in college thinking that, this is going to be important. I'm going to need to work. And I used to put out a newsletter, but it's just fatiguing anymore. Maybe I'll start doing a blog. I don't know. I need to find a kid that can come and set that up for me, because I don't have time to run it during the day. That's a big part of the reason I haven't done it. It takes not just the effort of writing the material, but just maintaining a website. That's a full-time job anymore. And especially if you want to place ads on it. So anyway, I always do this. I'll lose my train of thought here. By the way, I can tell typically how strong or weak the market's been in one day by these scans that I run on this software called Telechart. And I've got this, so I've run these scans that I used to use it for when I was doing individual stocks. And I set it up so that it's ranking all the stocks by relative strength. What is that? Well, relative strength just means if we look at the stocks at where they are today and how much they're up over the period, I use 6 months, how much they're up over the past 6 months, and we rank them from top to bottom. Well, this one went up 76%. This one went up 70%. Well, the 76% gets a higher ranking, so it's going to come up over the 70%. And that's all it is. So I want the fastest moving stocks. And then I also want their the amount of shares that have traded that day to be above their average over the past month. And sometimes it's no indicator is actually foolproof. But if you're getting an increase in volume and it's making a new high, short-term high, and then it closes up in the top half of the day. Okay, if the open high low prices for the day, like here's one that came up on a list. It's Delic Holdings. It's an oil and gas refining and marketing company. It opened, got as high as 48.50, got as low as 45.74. That's pretty significant, about 5%. And then it closed at, let's see, where did it close? At 48.32, up 1.39% for the day, near its high of the day. So how would you interpret that? I would say, well, that's a fairly strong day because it closed near the high of the day. It's already been going up. It's been doing very well. It's closed over the top, the high over the past 30 days, and the volume crept up a little bit. So why is that meaningful? You're going to have to wait until after the commercial break to find out. This is Bill Bullington right here on 1420. I'll be back after these messages. And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 10 to noon. If you'd like to call in today, the number is 216-901-0945. If you'd like to set up an appointment to talk about your own situation, you can go to my website. It's bullingtoncapital.com, and it's got all my contact info there. In fact, let me see. I just want to make sure that it's still up. Yes, it is. And it said sometimes we've been hacked. Actually, we're not really hacked. The company shut it down for a little bit because they were having some interior problems. But anyway, the number is in the office is 330-664-0700, 330-664-0700. So you can call us there if you have questions on anything you heard anything about here. And it's kind of wild after growing up in the era that I grew up in. People will only think we have problems now. There was this little thing called the Vietnam War. I was just a kid when that was going on, by the way. But I had aunts and uncles who were actually in their late teens, early 20s. And, boy, they were, had very long hair and very upset about a lot of that stuff. And I remember, I think we were living in Nashville, Tennessee, when they had that horribly traumatic event that happened at Kent State. So I remember hearing about it, being like 5 years old, and then when I went to school there, I walked around the grounds where all that stuff took place and learned a whole lot about it. And well, you hope that something like that never happens again. And looks like came close a few times here within the past couple months. But people, you have to remember that this is nothing new. This has gone on multiple times before, and before they had national news wires, there were a lot of stuff that was going on. This is behind the scenes, and I'd venture to say that crime rates are just more. They get more publicity now, so it's more on people's minds, and it really has a big impact on a lot of people. And the reason I'm talking about this is I've just had a few clients calling in, and they're really worried about a lot of the stuff that's going on in the world right now. And right in front of, they don't. It doesn't make anybody feel better to say, well, this has happened many times before, and it's probably going to happen again because we're humans, and this is what we have a tendency to do. And I know nobody likes that, but so I'm not going to say it to you if you call in because I've just said it here. And realistically, yeah, it is. There's always stuff to worry about. There is always stuff to worry about, and I have complete faith that we'll make it. I look at these young kids and how smart they are, and how much technology they're able to command at really young ages. That blows my mind, and I feel good. I feel good about it. I think there's a bright future, and the news is just, it's out there to be bad. I don't know, if I were king, I would make it a rule that you've got to report all the good news and the bad news. You got to report all the news. You can't just lean one way or the other to get ratings. And well, that would shake things up. This is why I'll never be king. I'll be assassinated in a heartbeat. I'm just kidding. Yeah, kind of. But anyway, it does make investing a little more challenging. I will tell you that economies worldwide are growing, and that's something that I think is, I don't think anybody talks about it enough. You go to countries around the world, and the United States is not the most advanced. I mean, no way. There are a bunch of small countries in Europe, because of their size, they're able to get things done a whole lot quicker because they're smaller. And they're significantly more advanced than we are, and not by little. So that part, and maybe if you're younger, that's already apparent to you. But a lot of people in the older generations, 40, 50, 60, they not so much so. And I almost never see media that talks about that at all. And it's just, information overload is as bad as not getting information, I think, or it can be. Not always, but it can be. And one of the things I try to do is get my clients, you got to focus on those things that are important that you can control and forget about everything else. It's not easy to do. And I get calls all the time. Hey, what do you think about this? And I'm going to tell you 99 out of 100 times, there's literally, we're already doing the right things. And there's a small percentage of the time, yeah, we should probably make an adjustment. It's probably more like 90 out of 100. It's for 10% of the time we can make adjustments to reduce risk somewhat. Now, doing that, when you go in and you reduce risk, there's only one way to do that. You've got to take some of the money out of the stock market, and you've got to put it somewhere safe, whether it's short-term treasuries, money markets, you name it. Passbook savings don't pay out. That just doesn't pay very much. We've got institutional money markets available to us. They typically are, they're in minimally the top 10% of the entire country. My primary custodian is actually Fidelity, and they're one of the largest fixed income managers on the planet, so that comes in really handy and very, very helpful. And again, so if you're trying to get together an idea of what you think your retirement would look like, or what you would want it to look like. A good time to start is when you're 12. And actually, I'm not kidding. Talk to your 12-year-olds. Tell them about how much money it takes to be able to retire. If you're going to use the 4% rule, show them to generate $40,000. You're going to need about $1 million. And that's why annuities are so popular, by the way, because they typically, it depends on your age. You have to, that's the thing. You have to really get some quotes, find out what kind of incomes you can generate. If you turn something on in an annuity, you got to remember that there are restrictions with that. So, look before you leap and consider all your options, what you're trying to accomplish, what your risk tolerance is. And that's one of the reasons that AI hasn't taken over our industry. They keep saying AI is coming, AI is coming. Well, you can fill out a questionnaire and feed it to or answer questions that the computer's asking you, but a computer's not going to be looking in your eyes. And I don't doubt at some point in time, that you're going to sit in front of a screen and it's going to ask you questions, and it's going to be measuring your heart rate and how much your pupils dilate when it shows you this is your portfolio, and here it is when it's down 25%. And it will measure how your body is reacting and your tone of voice, how you're breathing, and we'll design a portfolio specifically for you. But we're not there yet. We're not even close to that yet, and it would take an enormous amount of money. I'm absolutely sure that is coming. I just don't know when. And you'll still have people who look at the people who have a much higher risk tolerance, who are making a whole lot more money because they're putting up with more risk, and they'll be envious and like, I want that return. Well, you don't have the risk tolerance to take it. So unless you sign something that says, that we're going to put you in a portfolio that's probably got more risk than the tests revealed that you could tolerate, you're probably going to have to sit on the sidelines. And yeah, it's a good thing. It's coming. Actually, I thought it would already be here by now. I literally thought that would be the way that the market would run. It's only about 10 years behind schedule, and not really sure how long it'll take to get to that. During my earlier career, I went and I always read a lot, but I was reading about a car that somebody had a patent on. It looked like a big station wagon. It looked like a great big station wagon. But the car got 30 miles a gallon. The top speed was 70 miles an hour. And this is during the Depression when this patent was awarded. And it held 10 people. Think about that. 30 miles a gallon, 70 miles an hour back in the 1930s. I don't know where you'd be going that fast. But, and held 10 people. And the patent was awarded in the 1930s. The oil companies evidently bought all the intellectual property rights to produce that car and kept it off the market. At least that was the rumor. And I read that in a financial newspaper, by the way. So I'm not gonna name it because I don't want to hear from their attorneys. But anyway, it was pretty wild. I just thought this is public knowledge, and they were. We've been so far ahead, and there's no telling what kind of things that have been developed that we haven't seen. I think that's probably less likely these days, just because you've just got so many more people out there, and the world is so busy. And the one thing that has rung true, though, and when I stopped worrying about financial markets, was when I was in college. I didn't have any money to invest then, but I looked at the Federal Reserve System, and I was like, oh, wow. The This is real. That's super genius. Those people were incredibly ahead of their times. Let me put all that together, because we can heal our way and self-repair any damage that we do. Is it going to be easy? No. Heck no. But it's doable. And that's the thing. We can't dig a hole so deep that we can't get out of it. Now, you can come close. That's, if you get too far into debt, you just start printing money. Well, inflation, rampant inflation, you can just call us Venezuela. And by the way, that was the one of the big reasons that World War II happened. Because World War I reparations, the Germans didn't have a choice. They had to print the money and just hand it over. Hey, this is good currency. And there wasn't a whole lot of value behind it. And they were they got so taxed that they were having to pay so much that they loaded back up and nearly won. That's a trip. But anyway, I should probably stop talking about this, because most of the people that are listening to this are not anywhere near old enough to have read about that too much. So that's one of the things that I like about my industry. The average person that is looking for help is typically in their normally 40s, 50s, 60s, more commonly now 70s, because and some in their 80s. I've got some clients that call me up when they're in their 80s, and they're just looking for things to be able to generate income. In that case, in most cases, not always. Some people like I want aggressive growth. Okay, I want to grow my money. All right. I'm gonna have to ask you a lot of questions, find out, because I can't really do the right thing for you if what you think it is something different, And I've always been very, very particular about disclosing all the risk that you're taking, because you're going to find out whether it's me or not. That's sooner or later. Markets are tough. They're very difficult. And oftentimes, most people, I don't even have time to do everything anymore. That's why I signed up for some help. And I pay a lot of money for that too, by the way. And that doesn't come out of your account specifically. We have a flat fee across the board. And that's what so that covers all of our costs, covers your costs. You call me, I call you back. That's I spend most of my days, well, a big portion of my days, returning phone calls, which inevitably most of the time, I'm going to an answering machine if they've got one hooked up. But I will call you back. So anytime you have any questions, we try to be there for you. And we got Gary, Melissa, they're always available, and one of us will try to pick up and help you with your problems. As one thing in this world that they still haven't learned to eradicate are problems. Problems come up, and I'm surprised at what kind of problems are still coming up. At this stage of the game, I thought we would be a lot further ahead than what we are, and again, wrong. So it's not a problem. Anyway, going through the economic reports, it's not really, they're focusing right now on all the military stuff, and which they should, because when you're having conflicts like this, do you know how much money it takes to fund these types of things? Anyway, I got to take a real quick commercial break here, about the next 60 seconds. I'll be right back, and we'll finish this topic on what war really does to an economy. So. Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 10 to noon now. And I've got some stuff there. I was just looking at it. I won't have time to get to all of it today. I'm going to come back next week and finish this. It's some very good articles that came out in The Economist magazine. And one of them is talking about how Ukraine and Europe are working through some, they call it a squabble, conjugal squabble. And pretty fascinating. It's about how they're interacting with greater Europe, Donald Trump and Russia, trying to navigate all this stuff with all this conflict that's going on. And the stuff is distracting. It's interesting how a country who has a bone to pick with another country waits until there's a big distraction somewhere else, and then they, now's our time. Like, yeah, I don't know that I would be doing that. But again, I hate to say, this is not a silver lining. It is an economic benefit, though. When you start getting involved in skirmishes like these, if it develops bigger, yeah, it could end up really bad. But more often than not, knock on wood, hopefully this stuff gets settled relatively soon. But there's a big economic push that happens. Your economy actually has to put out more GDP, more production, because you're paying for all this stuff, and it's all happening overseas. That's a lot more expensive than projects that you would do here at home in your own backyard. So, if there's anything that you can gather from that, and it is horrible. I mean, I would hate to have a child that was serving in the armed services and is in harm's way. That's just that would be tough. I had a relative. I was named after. He was the World War II. They stationed him in Hawaii, and he didn't come back. So that's a really, really, really tough thing to have to put up with. Breaks my heart that stuff still happens. I didn't think when I was a young guy, I was like way too optimistic. I thought people, they will surely see the folly in doing that. Why would you do that? You could just come to an agreement, make deals, and move forward, everybody. And boy, was I optimistic. Yeah. So, but I'm still optimistic. I think things at some point in time, hopefully the sooner the better, they stop doing all this. It's just not a good, it's not a good thing for our kids, our grandkids. Yeah, it's not a good thing for us. And we need to get that stuff done, and there's always going to be some conflict because we're people. That's part of being people, and they don't agree on everything. And I'm absolutely positive as I'm speaking and talking this way that I'm probably making half the listeners upset. Yeah, and that's okay. I don't mean anything by it, and it's just speech, and I'm just observing, and I'm trying to look at the positive side to a lot of things. When I look at some of the scans I'm doing, I can tell you that the stock market's been really quiet this time. There aren't that many participants in or stocks that are going up pretty quickly that meet all the criteria that I normally look for. In fact, it's very minimal. I mean, I run these scans every day, and the scans from Friday, there are only 17 stocks that made the cut. Typically, on a good day, it'd be about 100 to 120. On a slow day, there'd be about 50. Well, on Friday, there were only 17. So what does that tell me? I've been doing this for so long that, all right, almost nobody is participating. The good news is we're not increasing with a whole bunch of new 52-week lows, stocks that are crashing. That's the good news. Market's not crashing yet. And if it does, it will come back. Again, I started to talk about this a little bit earlier, but the real genius behind the United States wasn't in my opinion, one of the geniuses, in addition to the Bill of Rights and having the type of government, democratic government, which has its negatives too, but is basically our financial markets. Markets, you can raise money here, you can build a business here. It's other countries have closed the gap a little bit, but for an incredibly long time period, America's banking system allowed us to grow a whole lot faster than other countries could. And I just don't understand why that's not really talked about very much. And maybe it is. Maybe every high school, because you could, the math now, the kids today learn the math by the time they're in the 7th grade to understand how banking works in America. And I just think they should start teaching this real early. It would reduce the number of people who don't participate in their 401ks. And there are I know a lot of people feel like they can't afford to participate, and in many cases that's true. They're not making enough money to be able to participate in a 401k. They need every dime that they get to be able to survive. You know how I know that? I've been doing this thing called a radio show for about 30 years. And I talk to them. And I am just flabbergasted at how strong some people are. They just do without to be able to put that money away. And it's not super common, but a lot of them are just incredibly well disciplined, and they're putting the money away even though there are tons of other things that they could be spending the money on. And they resist. And those people probably, they have a significant amount of need for that. So I feel obligated. I'm going to do the very best I can for all my clients. So you come in. My planning process is super simple. And like I said, most of the big financial institutions are adopting this thing that I've been doing since I started my practice. That's actually why I left their environment and went independent before that was popular. Well, it's because I looked at it and I thought, man, people don't even understand the questions you're asking them. That is idiotic. Let's break this down and make it as easy as you can. So, and I'll tell you exactly what it is. So when you're looking at building up assets for retirement, these are assets that you should be able to put away for 10 years. Your 401k, if you're a normal worker, is one of the best things you can do if you don't qualify for 401k because you make a whole lot of money, and somehow you've got an old product out there that your firm just never changed the data, the working, I forget what they call the books that they lay out the routines for their 401k plans. Anyway, there are rules, and every employer has a slightly different 401k plan. That's the thing about living in America and having so many attorneys here. We have the highest concentration of attorneys per person than any other country in the world. And it's good. I mean, you need them, but I'm not sure you need all of them. It creates a lot of extra work, and sometimes the documents. I don't know. Have you ever looked at a document, a 401k document? It's pretty intense. So anyway, it is a really good. It's one of the greatest investment vehicles ever because it comes out of your money pre-tax. You don't see it. It reduces the amount of discipline that you have to be a good investor if you don't have access to it, or if you're making more than you can contribute to the 401k and you've got money that you'd like to invest. That's great. Set up the accounts. There are a whole bunch of portfolios now that you can get, and you can get a customized approach. Almost everybody offers these now, and we've been doing it, from the get-go. And I actually, for the longest time, I really like the exchange-traded funds. There are about 3,000 of them, and because they're clearly defined. One of the reasons I like clearly defined is that you really don't know exactly what's going on. It's not nearly as common as it used to be, but when you have a mutual fund that has discretion, they're not going to basically put it in an index. They're going to pick stocks, even if they're using an algorithm, which is my favorite way to invest in, which is basically what ETFs do. They have a mathematical formula that selects the investments for that fund. You need to read that. I was just at this event and was invited there by a friend of mine. I'm sitting across the table from this lady who thinks she's super sophisticated, and I just kept my mouth shut for a couple of hours, and she's just ranking on financial advisors and how they're not necessary. I'm like, because she knows I'm a financial advisor. And so I just leaned over and said, listen, you know what? I've listened to you talk now for a couple of hours. And I just have a question. These funds that you're so fond of, the ones that you say you have these really good returns on, you may or may not. A lot of times people make that stuff up too. Do you have any idea what the price to sales ratios on the stocks in those are? And she looked at me like, okay, I'll take that as a no. So would you buy a house if you didn't know what the price per square foot was? I mean, think about that. That's one of the in real estate, that's one of the numbers they use, price per square foot. You can compare one house to another in a neighborhood, and it gives you an idea of how cheap or expensive that house may be. Without that number, you don't know if you're getting a fairly decent deal or not. You have nothing to compare it to. In the stock market, price to earnings ratio is not as reliable. It is important, but it's not as reliable as a price to sales ratio. There are a whole bunch of reasons for that, which I will not have time to discuss on today's program because I only have 5 minutes left. But maybe we'll come back to that next week. But anyway, if you don't know what your fund, how much your fund is paying, in other words, what the price to sales ratio is, the way that you're going to learn about that is when the fund drops a whole lot more than you thought it would, because you didn't know. You're investing in something, not looking at a valuation technique and a price to earnings ratio. The earnings are fine if you can verify that the earnings are accurate. Sales are a lot harder to manipulate. Okay, not that they can't. Okay, but it's a lot more difficult. So I feel like it's a much more reliable number, and this is what your portfolio manager should be doing for you. And when I'm looking at the portfolio managers that I chose for myself and for a lot of my clients, that's what I'm looking for. I want to see they're doing the homework. And if I'm going to be paying 0.5% more than somebody else, I want it to be worth it. On $1 million, that's it's like $5,000 a year. So I think it is. Yeah, it is. So anyway, I've only got about 60 seconds here. I apologize if I bored any of you to death today, but I'll come back next week and try again. Try not to bore you, to do better. But if you'd like to talk to me, you can call my office, 330-664-0700. Go to my website, it's bullingtoncapital.com. I'd be glad to discuss anything you have regarding financial stuff, investing in particular. And, I hope everybody has a good week. And I'm just going to say good investing and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.